$1.5 trillion in commercial real estate debt is coming due. Office towers, shopping malls, apartment complexes. The loans are maturing. The borrowers cannot refinance. Not at these interest rates, not with these vacancy rates. But here's the part no one is connecting. These bad loans are not just sitting on bank balance sheets waiting to be written down. They are being pledged as collateral in the overnight repo market. And when the repo market figures out that the collateral is hollow, the entire short-term funding system freezes. This is not about a real estate correction. This is about a collateral crisis that breaks the plumbing of the financial system. In this investigation, we are going to show you the invisible mechanism that connects empty office buildings to frozen bank liquidity. We are going to walk through the cascade step by step, from property defaults to repo haircuts to credit seizure. And we are going to explain why this is different from 2008. Because in 2008, the Fed could see the mortgage crisis coming. This time, the crisis is hidden inside the collateral stack, and by the time it becomes visible, the damage is already done. Educational analysis only, not financial advice. For 30 years, commercial real estate lending followed a simple cycle. A developer borrows money to build an office tower. The bank lends at a floating rate tied to SOFR or prime. The loan has a 5-year or 7-year term. When the loan matures, the developer refinances. They take out a new loan to pay off the old loan. The bank gets repaid. The developer keeps the building. Everyone wins. The system worked because of 2 assumptions. Assumption 1, interest rates stay low or decline. If you borrowed at 4% in 2018, you could refinance at 3% in 2021. Your debt service went down. Your cash flow went up. Refinancing was easy. Assumption 2, property values stay stable or rise. If you borrowed $70 million against a $100 million building, the building would be worth $110 million when the loan matured. The loan-to-value ratio improved. Banks competed to refinance you. Both assumptions are now broken. Interest rates have spiked. The loans that were written at 3% or 4% in 2020 and 2021 are maturing now in 2025 and 2026. To refinance, borrowers need new loans, but new loans are priced at 7% or 8%. The debt service doubles. Most properties cannot cover the new payments. The cash flow does not support the debt. Property values have collapsed, not across the board, but in specific sectors. Office buildings are the epicenter. Remote work killed demand. Occupancy rates in major cities have fallen from 95% to 60%. A half-empty building generates half the rent. The net operating income falls. The building is worth less. A property that was valued at $100 million in 2021 might appraise at $70 million today. The loan-to-value ratio inverted. The borrower is underwater. This is the double shock. Higher rates and lower values. And it is hitting simultaneously. Approximately $1.5 trillion in commercial real estate debt is maturing between now and 2027. The borrowers cannot refinance at current rates and current valuations. They are trapped. Now let me show you the mechanism that no one is watching. When a bank makes a commercial real estate loan, it does not just hold the loan on its balance sheet and wait for interest payments. It uses the loan as collateral to borrow money in the repo market. Here is how repo works. A bank owns a commercial real estate loan worth $50 million. It goes to the repo market and pledges that loan as collateral. A money market fund or another bank lends the bank $40 million in cash overnight. The next day, the bank repays the $40 million plus interest and gets the collateral back. This happens every night. It is called a repurchase agreement, repo. The key number is the haircut. If the loan is worth $50 million and the lender only gives you $40 million in cash, that is a 20% haircut. The haircut reflects risk. If the collateral is high quality, the haircut is small. If the collateral is risky, the haircut is large. In normal times, a commercial real estate loan might get a 10% to 15% haircut. You can borrow 85 to 90 cents on the dollar. But haircuts are not static. They adjust based on perceived risk. And right now, the repo market is starting to reprice commercial real estate collateral. Here is the cascade. A bank holds a loan secured by an office tower in San Francisco. The loan was made in 2020 when the building was 95% occupied and valued at $100 million. The bank pledged that loan in the repo market and borrowed $85 million against it. Everything worked. But now it is 2026. The building is 55% occupied. Tenants are not renewing leases. The property is worth $70 million, maybe less. The loan is still on the books at $100 million. But the repo lender knows the real value has collapsed. They do not trust the collateral anymore. The repo lender increases the haircut. Instead of lending $85 million against the loan, they will only lend $50 million, or they reject the collateral entirely. We are not taking CRE loans as collateral anymore. Bring us treasuries. This is the mechanism. The bad real estate loan becomes bad repo collateral. And when repo collateral gets rejected, the bank faces a liquidity crisis. Let me walk you through the cascade layer by layer. This is not a single event. This is a multi-stage collapse that amplifies at each level. Stage 1, property owner defaults. So the office tower owner in San Francisco cannot refinance the loan. The new rate is 8%. The building generates $2 million in net operating income. At 8%, the debt service on the $70 million loan is $5.6 million per year. The income does not cover the debt. The owner has 3 options: inject new equity, sell the building, or default. Injecting equity means putting in cash to pay down the loan and make the numbers work. Most owners do not have the cash. Selling means taking a loss. If you sell a $70 million building to pay off a $100 million loan, you lose $30 million. Most owners are not willing to crystallize that loss, so they default. They hand the keys to the bank. The building is now the bank's problem. Stage 2, bank takes the loss. When the borrower defaults, the bank forecloses on the building. The bank now owns a half-empty office tower worth $70 million, but the loan on the books is still $100 million. The bank has to write down the loan. They take a $30 million loss. This hits the bank's capital. If the bank has thin capital buffers, the loss threatens their regulatory ratios. They need to raise capital or shrink the balance sheet. But here's the problem. This is not one loan. This is happening across the portfolio. Regional banks hold disproportionately large concentrations of commercial real estate loans. A regional bank might have 30% to 40% of its loan book in CRE. If 10% of those loans default, the losses are catastrophic. A $10 billion CRE portfolio with 10% defaults and 30% loss severity means $300 million in losses. For a small bank with $1 billion in equity, that is a 30% capital hit. The bank is crippled. Stage 3, repo market. Rejects the collateral. While the bank is taking losses on defaulted loans, it still has hundreds of other CRE loans on the books that have not defaulted yet. These loans are still pledged in the repo market. But the repo lenders are watching the defaults. They see the write-downs. They know the risk is spreading. The repo lenders increase haircuts across the board, not just on the defaulted loans, on all CRE loans. If a bank was borrowing 85 cents on the dollar, now they can only borrow 60 cents. If they were borrowing against $5 billion in CRE loans and getting $4.25 billion in cash, now they only get $3 billion. They just lost $1.25 billion in overnight funding. This is the liquidity squeeze. The bank needs that cash to fund daily operations, to meet withdrawal requests, to clear payments. When repo funding disappears, the bank has to find replacement liquidity immediately. They can borrow from the Federal Home Loan Bank system. They can sell securities, they can draw down reserves, but all of these options are expensive and limited. Stage 4, credit contraction begins. As the bank scrambles to replace lost repo funding, it cuts lending. New commercial loans are denied. Lines of credit are reduced. Small business loans are called. The bank is in survival mode. It is hoarding liquidity and shrinking risk. This creates a doom loop. When banks stop lending, businesses cannot finance operations. They cut spending. They lay off workers. Commercial tenants go bankrupt. This increases vacancy rates in commercial properties. Property values fall further. More loans default. Banks take more losses. Repo haircuts increase again. The loop accelerates. Stage 5. Contagion spreads to healthy banks. At first, the crisis is contained to banks with heavy CRE exposure, but repo markets do not discriminate cleanly. When haircuts increase on CRE collateral, the repricing spreads. Repo lenders start questioning all non-treasury collateral, corporate bonds, mortgage-backed securities, asset-backed securities. If CRE collateral is worth 30% less than face value, how do we know other collateral is not also overvalued? This is the contagion mechanism. Fear spreads faster than facts. Repo lenders increase haircuts across asset classes. Even banks with minimal CRE exposure face higher funding costs. The entire short-term funding market tightens. Liquidity becomes expensive. Credit freezes. But here is what makes this crisis different from 2008. In 2008, the problem was visible. Mortgage defaults showed up in data. Home prices fell in public indices. The Fed and Treasury could see the crisis building and design interventions. This crisis is hidden inside the collateral stack. The loans are still performing on the surface. The defaults have not hit critical mass yet. The buildings are still standing. But the collateral value is eroding invisibly. By the time the repo market fully reprices the risk, the liquidity damage is already done. Banks that were solvent yesterday face funding crises today, and there is no clear intervention point. The Fed can lend to banks through the discount window, but that requires the bank to have eligible collateral. If the CRE loans are no longer accepted as repo collateral, they might not qualify for Fed lending either. The Fed can buy assets. But buying impaired CRE loans is politically toxic. It is a direct bailout of commercial real estate investors. Congress would revolt. This is the trap. The crisis is invisible until it is not. And when it becomes visible, the tools to stop it are limited. Let me translate this systemic crisis into tangible impact, because when the repo market freezes and banks hoard liquidity, the effects show up in your life within weeks. Your business line of credit gets cut. If you run a small business and rely on a revolving credit line for working capital, the bank calls you. We are reducing your line from $200,000 to $100,000. We need to strengthen our liquidity position. You did nothing wrong. Your business is profitable. But the bank is in crisis mode. They are pulling back from all risk. You now have half the cash flow buffer you had last month. If a big customer pays late, you cannot cover payroll. Your commercial lease terms change. If you rent office or retail space and your lease is up for renewal, the landlord is desperate. Vacancy is climbing. They need tenants. They offer you a discount to renew. This sounds good, but it is a symptom of a collapsing market. The landlord is cutting rent because they are on the edge of default. If they default, your lease might be voided. You could be forced to relocate mid-year. Your business continuity is at risk. Your local bank closes branches. Regional banks facing capital losses and liquidity stress cut costs. They close branches. They lay off staff. If your primary bank is a regional player, your access to in-person banking shrinks. Online banking works until it doesn't. If there is a technical issue or fraud flag and there is no branch to visit, you are stuck. Your business accounts could be frozen for days while customer service sorts it out. Your financing costs spike. Even if you can still get credit, the price goes up. Banks facing higher funding costs pass those costs to borrowers. If you are financing equipment or vehicles or inventory, the interest rate you're quoted today is higher than it was 3 months ago. A loan that would have cost you 6% now costs 9%. Your monthly payments increase. Your profit margins shrink. Your commercial property value collapses. If you own commercial real estate, even if you're not in default, the comps are falling. When office towers in your city are selling at 30% discounts to 2021 prices, your property is marked down too. If you need to sell or refinance, you take a loss. If you hold and wait, you're betting that the market recovers. But if the doom loop accelerates, recovery could take a decade. This is the wealth destruction mechanism. Not dramatic, not a single catastrophic event, just a slow, grinding contraction of credit and liquidity that squeezes every business and property owner simultaneously. You feel it as higher costs, reduced access, and collapsing asset values. But the root cause is invisible. It is a repo market haircut on a loan you have never heard of, secured by a building you have never seen. We have mapped the invisible mechanism from the $1.5 trillion maturity wall to the collateral crisis in the repo market. From bad loans, to rejected collateral, to frozen liquidity. The cascade is mechanical, it is predictable, and it is already in motion. So how do you know when the crisis is accelerating? When the invisible mechanism is becoming visible, there are 3 signals to watch. Signal 1, regional bank deposit outflows accelerate. Regional banks publish deposit data quarterly. If you see a regional bank report a 5% or 10% drop in deposits in a single quarter, that is a run in slow motion. Depositors are moving money to larger banks or money market funds. The regional bank is losing funding. This forces them to rely more heavily on repo and Federal Home Loan Bank borrowing. If repo haircuts are increasing simultaneously, the bank is trapped. Watch the FDIC quarterly data. If multiple regional banks show deposit declines in the same quarter, the contagion is spreading. Signal 2, Federal Home Loan Bank advances spike. The Federal Home Loan Bank system is the lender of last resort for regional banks. When a bank cannot get repo funding or retain deposits, it borrows from the FHLB. The FHLB publishes monthly data on advances. If you see advances jump by 20% or 30% in a single month, it means banks are desperate for liquidity. This is not normal. This is crisis borrowing. It happened in March 2023 when Silicon Valley Bank and others collapsed. If it happens again, it is a red flag. Signal 3, CRE loan delinquency rates cross 5%. The Mortgage Bankers Association tracks commercial real estate loan delinquency rates. Historically, delinquency rates sit at 1% to 2% in normal times. In a recession, they climb to 4% or 5%. If CRE delinquencies cross 5% and continue rising, defaults are cascading. This is the point where losses overwhelm bank capital buffers. Regulators start emergency interventions. The repo market fully reprices the risk. Watch the MBA data releases. If the trend is accelerating, the crisis is no longer invisible. These 3 signals are public. They are measurable. They are early warnings. If you see 1 signal, pay attention. If you see 2, prepare. If you see all 3, the repo collateral crisis is here. This investigation has shown you the mechanism that connects empty office buildings to frozen bank funding. The $1.5 trillion maturity wall is not a distant problem. It is a current crisis hidden inside the collateral stack. The loans cannot be refinanced. The properties cannot be sold. The banks cannot absorb the losses, and the repo market is starting to reject the collateral. The cascade is mechanical. Property defaults lead to bank losses. Bank losses lead to higher repo haircuts. Higher haircuts lead to liquidity crises. Liquidity crises lead to credit contraction. Credit contraction leads to more property defaults. The doom loop feeds itself. The question is not whether this happens. The question is how fast. If defaults accelerate slowly, banks can manage the losses over time. Regulators can intervene selectively. The damage is contained. But if defaults spike quickly, if repo haircuts jump suddenly, if contagion spreads across the regional banking system, the crisis overwhelms the circuit breakers. And the Fed faces the same impossible choice we have seen before. Print money to bail out the system and reignite inflation. Or let the system purge and risk a depression. There's no good answer, only trade-offs. And the trade-offs are becoming visible right now in the repo market pricing of commercial real estate collateral. The invisible mechanism is still invisible to most people, but it is becoming visible to the people who matter. The repo lenders, the bank treasurers, the regulators. And once it is fully visible, the crisis moves to the next phase. Stay informed, watch the signals, and remember, in a collateral crisis, the damage is done before the headlines arrive.